The Japanese yen has recently experienced a significant drop in value against major currencies, raising concerns both domestically and internationally. The yen's depreciation has been particularly noticeable against the US dollar, with the exchange rate crossing the 150 yen per dollar mark, a level not seen in decades. This sharp decline has prompted intense scrutiny of Japan's economic policies and the broader global financial environment as investors seek to understand the underlying causes of this currency movement.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
One of the primary factors driving the yen's decline is the widening interest rate differential between Japan and other major economies, especially the United States. The Bank of Japan BOJ has maintained an ultra-loose monetary policy, keeping interest rates near zero or even negative in an effort to stimulate domestic economic growth. In contrast, the U.S. Federal Reserve and other central banks have been raising interest rates aggressively to combat inflation. This divergence has made the yen less attractive to investors, who prefer the higher yields offered by U.S. assets. Another contributing factor to the yen's weakening is Japan's persistent trade deficit. The country has been importing more than it exports, particularly in energy and raw materials, which have become more expensive due to global supply chain disruptions and rising commodity prices. The increased cost of imports, combined with lower demand for Japanese exports, has put additional downward pressure on the yen, exacerbating its decline on the global stage. The drop in the yen's value has mixed implications for Japan's economy. On one hand, a weaker yen makes Japanese exports cheaper and more competitive in international markets, which could boost the country's manufacturing sector. However, the benefits of a weaker yen are being offset by the higher cost of imports, especially energy, which is a critical concern for a country heavily reliant on foreign energy supplies. The rising cost of living for Japanese consumers, driven by more expensive imports, is also a significant downside. Japanese policymakers are facing growing pressure to address the yen's decline. The BOJ has so far resisted calls to raise interest rates, fearing that doing so could stifle the fragile economic recovery from the COVID-19 pandemic. Instead, the government has intervened in the currency markets, purchasing yen to prop up its value. However, these efforts have had limited success, as market forces continue to drive the yen lower. Internationally, the yen's depreciation is being closely watched by other countries, particularly in Asia. Japan's neighbors, such as South Korea and China, are concerned that a weaker yen could lead to a competitive devaluation in the region, potentially sparking a currency war. The yen's drop is also influencing global financial markets as investors adjust their portfolios in response to the changing dynamics of currency exchange rates. The ongoing weakness of the yen is also affecting global businesses with exposure to Japan. Companies that rely on Japanese suppliers or have significant operations in Japan are facing higher costs, which could impact their profitability. On the other hand, foreign tourists visiting Japan are finding that their money goes further, making Japan an even more attractive destination, although this is somewhat tempered by ongoing travel restrictions related to the pandemic. Despite these challenges, some analysts believe that the yen's decline could eventually stabilize or even reverse. They point to potential shifts in global economic conditions, such as a slowdown in U.S. interest rate hikes or a recovery in Japan's trade balance, which could reduce the downward pressure on the yen. However, the timing and likelihood of such changes remain uncertain, leaving the yen's future trajectory unclear. In response to the yen's drop, Japanese corporations are also adjusting their strategies. Some companies are accelerating plans to diversify their supply chains and reduce their reliance on imports, while others are exploring new markets for their exports to take advantage of the weaker yen. Additionally, Japanese firms are increasingly hedging their currency exposure to mitigate the risks associated with further declines in the yen's value. Overall, the yen's recent decline is a complex issue with far-reaching implications for Japan and the global economy. While some benefits may arise from a weaker yen, particularly for exporters, the risks and challenges associated with higher import costs and potential regional instability cannot be ignored. As the situation continues to evolve, policymakers and businesses alike will need to remain vigilant and adaptable to navigate the uncertainties ahead. The yen's persistent decline is causing ripple effects across various sectors of the Japanese economy, with notable impacts on the stock market. Japanese equities have seen mixed reactions as investors weigh the benefits of a weaker yen for exporters against the potential downsides for import-dependent companies. Major exporters like Toyota and Sony have experienced stock price boosts as the weaker yen makes their products more competitively priced abroad, thereby increasing their profit margins when revenues are repatriated. Conversely, companies heavily reliant on imported goods and raw materials are grappling with rising costs, which could squeeze their profit margins and depress their stock prices. Another area significantly affected by the yen's depreciation is Japan's bond market. As the yen weakens, Japanese government bonds JGBs have come under pressure, with yields rising slightly despite the BOJ's efforts to maintain low rates. The weakening yen has led to increased inflation expectations, which, while still modest by global standards, could undermine the BOJ's long-standing objective of keeping bond yields low to stimulate the economy. Investors are increasingly cautious about holding JGBs in an environment where the yen is depreciating and inflation risks are edging higher. The yen's fall has also led to broader concerns about Japan's economic sovereignty. A weaker yen can lead to capital flight as both domestic and foreign investors seek higher returns in other currencies, potentially destabilizing Japan's financial system. Moreover, the reliance on foreign investment to fund Japan's substantial government debt becomes riskier when the yen is weak, as the real value of returns to foreign investors diminishes. This situation places Japan in a delicate position, needing to balance economic growth with financial stability. Tourism, one of Japan's key industries, stands to benefit from the yen's decline, although the recovery in tourist numbers post-pandemic has been gradual. A weaker yen makes Japan a more affordable destination for international travelers, which could lead to a surge in tourism once global travel fully normalizes. However, the benefits of increased tourism could be partially offset by the rising costs of imported goods and services that support the tourism industry, potentially limiting the economic boost from this sector. In the retail sector, Japanese consumers are feeling the pinch of the yen's decline more acutely. Imported goods, from foodstuffs to electronics, have become more expensive, leading to higher retail prices. This has put pressure on household budgets, particularly as wages in Japan have not kept pace with the rising cost of living. The combination of stagnant wages and rising prices is likely to dampen consumer spending, which is a critical driver of the Japanese economy. The energy sector is another major area of concern, given Japan's heavy reliance on imported fossil fuels. The yen's decline has significantly increased the cost of these imports, contributing to higher energy prices for both consumers and businesses. This is particularly problematic as Japan continues to recover from the economic impact of the pandemic and as the country faces challenges in transitioning to more sustainable energy sources. The higher cost of energy imports could also exacerbate Japan's trade deficit, putting further pressure on the yen. Looking ahead, some economists warn that the yen's depreciation could lead to inflationary pressures that Japan is ill-prepared to handle. While the country has struggled with deflation for decades, the current environment is different, with supply chain disruptions and global inflation trends adding complexity to the economic outlook. If the yen continues to weaken, imported inflation could become a significant problem, eroding the purchasing power of Japanese consumers and potentially leading to a period of stagflation, a combination of stagnation and inflation. The geopolitical implications of the yen's decline should not be underestimated either. As one of the world's major currencies, the yen plays a crucial role in global trade and finance. A sustained weakening of the yen could shift the balance of economic power in Asia, particularly if it prompts competitive devaluations from other regional currencies. This could lead to increased economic tensions in an already volatile region, with broader implications for global trade and diplomatic relations. In response to the yen's fall, the Japanese government has been considering additional fiscal measures to support the economy. These could include targeted subsidies for sectors most affected by rising import costs, as well as broader stimulus measures aimed at boosting domestic demand. However, with Japan's public debt already among the highest in the world, there is limited fiscal space to maneuver. Any new measures will need to be carefully calibrated to avoid exacerbating the debt burden while still providing meaningful support to the economy. Finally, the yen's decline is a wake-up call for Japanese policymakers to rethink their long-term economic strategy. The challenges posed by a weaker yen highlight the vulnerabilities in Japan's current economic model, particularly its reliance on exports and imported energy. As the global economy continues to evolve, Japan may need to focus more on fostering domestic innovation, increasing energy efficiency, and diversifying its trade partnerships. These steps could help mitigate the impact of currency fluctuations and ensure more sustainable economic growth in the future.
Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.